Okay, dude, in the question right below, yes, like right below this one, next question, they have asked you to like over here, they have asked you to identify the type of error made in number 6 and number 7. I'm not being able to show you the question exactly over here because this is just a screenshot of that page. This is not the PDF which you had sent me. Yes, so they have asked you to identify the kind of error. Okay. Now I went back to your book and found out that there are 6 kind of errors which can happen. Error of commission. Yes. Like when there is anything related to commission, I think that is called error of commission. Error of complete reversal when you record the ulta entry. Like suppose you're supposed to record the drawings to cash, D to C, but instead of that you record cash to drawing. That is what you call error of complete reversal. Error of omission when you forget to record something. Error of original wait error of original entry is also the same. No, error of omission means when you forget one account, like that. And error of original entry when that is when it was recorded wrong or it is not recorded only. And then there is error of principle, which is a conceptual mistake, and compensating errors means this thing, like the things which we do to correct it. Compensating errors, exactly, like since the explanation is not given, I won't be able to tell you. So what type of error is number 6? Number 6, vehicle cost of the vehicle repair is $190, has been debited to the motor vehicles account. Yes. So this thing is a, what kind of error is this? Dude, this thing I think is an error of principle. Yes, because he should have recorded it as repairs account debit. Yes, and by mistake he has done motor vehicle account debit. Yes, this thing is an error of principle. Okay, and payment made to Robert has been posted to the account of Roberta. What kind of this thing is this? This is error of original entry, I guess. Yes, this will be error of original entry. Okay, dude, we have been given some errors over here. Yes, and in the next sum they have asked us to calculate the corrected profit. Yes, net profit was 6720. Yes, and then you are supposed to calculate the corrected profit. Like for example, the first one, purchases overcast. A reduction in purchases is the reduction in the money flowing out. Like we reduced purchases, we credited purchases, which means that we reduced purchases. That was a reduction in the money which was flowing out, and that's why it increased the profit. It is recorded under increase in profit. Yes. So now let's see what effect are the other ones having. Okay, dude. So next one is discount allowed. Here discount allowed has been debited. Yes. So this thing discount allowed is an expense of ours. Yes, and when it has been debited, yes. So when the expenses increase, the profit reduces. So this will be recorded in decrease. This will be recorded in decrease in profit. Sorry, that is error 2 now. So it will be recorded in decrease in profit. And again, insurance is an expense, it has been debited, so that will be recorded in decrease in profit. Error 3 also decrease in profit. And next, commission payable has been credited, means an expense is reducing and income is increasing. Commission payable has been credited means what? Expense is reducing, and commission received has been credited means we are getting a new income after the error. Yes, so both of them will lead to increase in profit. So it will be recorded over here as $130 an increase in profit. Yes, and again drawings is an expense, it has been debited, so it will lead to decrease in profit. Yes, and repairs and these two 1 minute. Yeah, dude. So repairs is an expense, and when that is being debited, that will lead to decrease in profit. So we will write, we will put it in the decrease in profit column. Yes. And Robert account debit to Roberta, both of them are personal accounts, and they will be recorded directly in the statement of financial position and not over here. Yes. So then you will calculate the entire thing, add and subtract, and then you will get to the final amount. And do next one also relates to our syllabus. 300 owed by DD supply should have been written off as irrecoverable. So it should have been irrecoverable debts account debit, because it is an expense. Irrecoverable debts or bad debts are our expense, so it will be debited. Yes, and what will be credited? This DD supplies will be credited. Yes, and provision for doubtful debts, it is, it is PBDD, which is provision for doubtful debts debit, to trade receivables, to TR, the journal entry, and it will be 2% of the trade receivables. And what is the trade receivables? 14,500. So it is 2 by 100 amount, you will write as 2 by 100 into 14,500, so it will get cancelled out. And what is the amount which she owes to, like, acha, here though the amount is given $300, so nothing to worry about. Okay, dude. So in the next sum of the first paper, they have asked you to calculate the open rate of inventory turnover. Yes. So this is the thing which relates to our syllabus. It is the formula for calculating rate of inventory turnover is this thing, cost of sales by average inventory, or is it the opposite, average inventory by cost of sales? One. Yeah, dude, it is cost of sales by average inventory. So how do you calculate the cost of sales? Opening inventory, yes, add purchases minus closing inventory will give you the cost of sales. Yes, so once you get the cost of sales, you will divide it by average inventory. Average inventory means what? Opening inventory plus closing inventory divided by 2. Yes, so that you will put over here, and then you will divide cost of sales and average inventory. The answer which you will get, that is your uh, that is your rate of inventory turnover. And explain the effects of change in inventory turnover. Like, this is the next question. Explain the effects of change in inventory turnover. 1 minute. Okay, dude. So explain the effects of rate of inventory turnover. Rate of inventory turnover, the definition, as you know, that the definition of the rate of inventory turnover is that the number of times, like, 1 minute, let me show it to you only. Yeah, rate of inventory turnover is the number of times a business replaces its inventory in a given period of time. So you will write that change in, like, increase in rate of inventory turnover shows us that the business is replacing its inventory very fast, that is, sales are high, and vice versa. When does a business replace its stock of goods very fast? Like, when there are high sales, the stock empties up, and then they need to get new stock. Yes, so this is the thing which you're going to write. And I think, too, that's it with the first paper. Yes.